Hello class. Today we're going to talk about Marco Polo. Now, do you all know who Marco Polo was? Well, he was an Italian guy, and way back in the 1200s, at the age of 17, he departed on a journey with his uncle and several other merchants from Venice into the very distant regions of Central Asia and China and areas beyond. And they stayed away many years. They were among the very first merchants to venture from Europe into the vast regions of Asia. And when they returned, they had amassed vast amounts of wealth and property and goods, and they built huge multinational trading empires upon these journeys and this situation. In fact, in those days, the Venetians occupied a very unique niche in the business world. They acted as the middlemen between the primitive kingdoms of Europe and the vast wealthy empires of Asia. And so as middlemen, they built up these great trading enterprises. Now, why do I mention Marco Polo? Well, because it was just about that same time in history where the first records of the accounting system that we know now came into being. And we can see that these records and this system that was in use in those days by these Venetian merchants is nearly the same system that we use today. In fact, in the early days, it was referred to as the Venetian method. Now, let me give you a sense of how it came into being, and we'll take a simplified kind of story here. Let's say you are a Venetian merchant, and you've got a big trading business, very complicated. You need to keep records of your transactions and your goods and your property and all of that kind of thing. You need to keep records. You need information. Remember, accounting is all about information, the information we need so that we can conduct our business. So they had people to keep these records, the first accountants. Now, let's see how this system might have started. Let's look at this diagram here. We have a table that starts out like a big letter T. We have a left side and a right side. Let's start this way. On the left side, let's list the assets that this merchant might have. What are assets? Those are things that have value. So let's say, for example, this merchant had cash. Add up all the cash, and let's say, hypothetically, $1,000 worth of cash. Doesn't matter what kind of currency we use here. Now, what other kinds of assets might this merchant have? Well, he would have merchandise inventory. Those are the goods he was selling, to his customers. Merchandise. Let's say he had $1,000 worth of merchandise. Now, what other kind of assets? Perhaps he owned 3 or 4 ships that he used for transporting his goods. Let's list ships. Maybe his ships were worth $2,000. What else? Well, he probably owned lots of property, land and buildings, maybe docks and wharfs, maybe warehouses to store his goods, maybe palaces to entertain the great officials that have come from other lands. Let's just list them all as property. And maybe his property was worth $4,000. Now we can add up all the assets. Now that's some pretty useful information. We know the assets we have, what they're worth. But does this give us a complete and full picture of the merchant's financial position? Not yet. What have we not yet taken into account? The liabilities. Let's list the liabilities on the right side of the table. What do we mean by liabilities? That's amounts that you owe to other people. So, what kind of debts might this merchant have had? Well, he probably had what we call trade payables, meaning that his suppliers would ship goods to him. He'd received the goods, but had not yet paid for them, and so he had certain amounts that he owed to his suppliers, and he would pay them on a regular basis. But at this point in time, let's say he had trade payables of $1,000. And let's say that he also had bank loans. He might have needed to borrow money from the banks for temporary working capital or some purpose like that. In fact, in those days, there was already quite a sophisticated banking system in place in Europe. Let's just call them bank loans. Let's say he had $1,000 of bank loans. Now we're beginning to get a fuller, more complete picture. We have assets totaling $8,000. We have liabilities totaling $2,000. So we get a full picture, and if we want to find out what is the net worth of this business, and what do we mean by that? Now remember, the word net means to combine two things together, typically things that are offsetting. You see, if this merchant needed to pay off his liabilities, he would have to use some of his assets to pay the liabilities. So the liabilities go to reduce the value of the assets. So if we net them together, we get net worth of how much? $6,000. Let's list the net worth over here. Now we're beginning to get a better, fuller picture. So, we see assets, liability, and net worth. Now, watch this final trick. It's a good one. We add up the right side. Left side and right side are in balance. What do we call that? I'm sure you guessed it. That's a balance sheet. That is a balance sheet. And notice the way we define net worth as the difference between these two ensures that the balance sheet will always be in balance. Always be in balance. And this system of a balance sheet that was developed back in the 1200s in Venice is exactly the same system we use today. Hope you've learned something.